One fund, on point for today, the expert to talk about it. Welcome to the ETF of the Week. Yes, this is the ETF of the Week, where we examine trending, new, newsworthy, unique, and intriguing exchange-traded funds with Todd Rosenbluth. He's the head of research at VettaFi. And at VettaFi.com, you will find every tool you need to be a better informed, with better results kind of investor in exchange-traded funds. Todd Rosenbluth, it is great to chat with you again.
It's great to be with you again, Chuck.
Your ETF of the week is
the SPDR Portfolio S&P 600 Small Cap ETF, SPSM.
SPSM, the SPDR Portfolio S&P 600 Small Cap ETF. Now, everybody's known about market concentration and the rest, and here we are talking as I set up that intro. Well, there's trending, there's newsworthy, there's unique. This is not new, and it's not unique. There's plenty of stuff in the small cap space. So why this fund now?
So we think that small caps have been out of favor with investors. In fact, we've had the equity markets for the last almost 2 years be driven by the Magnificent Seven stocks, those mega cap growth stocks. Some of them have moved out of favor. Small caps have become a smaller, pun unintended, slice of buy and hold investors' portfolios just because of the market movements. So we think many people are underexposed to small caps. We can dive into more closely why this index, but we think that the S&P 600 is a higher quality and perhaps more appropriate index given the environment that we're in. And State Street has really used its scale as an advantage. We think that a 3 basis point exposure for this ETF makes a lot of sense. And I guess lastly, we are in a time period that if the Fed cuts interest rates, because we've seen inflation adjust, we think small caps could return to favor. So now is a good time to focus on small caps.
Let's dig into the index, but not just the construction of the index, but why you want to use an index fund here instead of active management. Because, well, at VettaFi, you're looking at every ETF, but a lot of times on the ETF of the week, you're looking at that new fund or that new twist or what have you. And this is about as classic as you get. So why this index, but maybe first, why index versus active in this space?
So we want to give investors choice. There's 3,000 plus ETFs to consider. I come on a weekly basis. So I think I've come on recently and talked about active management because there are certainly some active managers that have demonstrated success. The firm they have the heritage within that space, but it is hard for active management to consistently outperform an index. And that is the case in the small cap realm as well. The SPIVA scorecard, which is from S&P, it's the index versus active, shows how hard it is for consistently outperformance and over a long time frame to outperform this small cap index. So we think an index-based approach can make sense for certainly buy and hold investors, and rather than them sorting through who are the best active managers and whether those managers can come into play. And then you want to then decide which index-based approach makes sense. And that's where you get into the nitty-gritty under the hood that I love to talk about with you.
This is a fund that if somebody has limited small cap exposure, well, this gives you broad small cap exposure. Is this a permanent allocation choice for people? Like if you haven't had small cap, yes, this is a time to be getting it, but you expect to hold it forever? Or is this the kind of thing that, well, tilt your portfolio a little bit in this way, and at some point in the future, tilt away from it if small caps don't turn out?
So a broad small cap ETF like SPSM is perfect to be part of a strategic portfolio. So most people are starting with their equity exposure with a large cap, probably tied to the S&P 500, whether that's from iShares, from Vanguard, from State Street. Those are the three firms that offer those broad market strategies. We think SPSM can fit in nicely as part of the core. You take on obviously a bit more risk with small cap under or unfollowed companies, less proven companies. It'll be a smaller slice of the portfolio tied to small caps, but we think a healthy, high single digit exposure to small caps could make sense for investors. And then you want to continue with any asset allocation strategy and revisit it and rebalance to make sure you sell some of your winners, you add to some of your losers. And SPSM, because it's just 3 basis points, can be a great way of doing that and having exposure. And I guess lastly, since I mentioned the S&P 500, there's no overlap between the S&P 500 companies and the S&P 600 small cap companies. It's the same index company. So a company like Abercrombie and Fitch, which is currently the largest of those companies within SPSM, you're not going to find that within the S&P 500. It's completely different index.
One of the things you said in there was a high single-digit exposure to small caps. Like that is the allocation choice you're doing. But the other thing about small caps, unlike a lot of funds that we talk about here on the show, because we're literally talking about an index, et cetera, you can look at historical performance. And the historical norms, if you're talking about like the Ibbotson study of market returns, is that the stock market returns 10%. That's large cap stocks. And small caps typically return a little bit better than that. It's been historically closer to 12%, though not recently. So the question is, if somebody's going to make this that high single-digit piece of their portfolio, do you expect that over time, if you hold it long enough, you will do better here than you will just with large caps? Because historically, that's been the expectation.
So historically, small caps or size and low size has been a relatively strong performance. So size or small size and value-oriented stocks have historically done better. That hasn't been the case in recent years. We've seen large caps continue to outperform, creating what we think is a buying opportunity and with a high-quality tilt, because the S&P 600 requires companies to have a consistent earnings record in order to be a constituent. So you should certainly have some exposure to small caps. You should hope that it outperforms, but you're going to take on more risk. The companies that are in the S&P 600 are less proven companies than the Apples, the Microsofts, the Coca-Colas that you'd find within the large cap. So you'd want to have a healthy mix of diversification. I definitely have said that time and time again on this program.
Absolutely, you have. But this time, the advice looking at a classic fund that hasn't been focused on before. It's the SPDR Portfolio S&P 600 Small Cap ETF. The ETF of the week from Todd Rosenbluth at VettaFi. Todd, great stuff. Thanks so much as always. We'll see you next week.
I'll see you next week, Chuck.
The ETF of the week is a joint production of VettaFi and Moneylife with Chuck Jaffe. And I am Chuck Jaffe. And you can learn all about my hour-long weekday show by going to MoneyLifeShow.com or by looking wherever you find great podcasts. To learn more about investing in ETFs and make yourself a better investor, check out VettaFi.com. All the tools they have there will help you. They're on Twitter at Vetta_Fi. Todd Rosenbluth, their head of research, my guest. He's on Twitter too. He is at Todd Rosenbluth. We're here every week for you with the ETF of the week. Follow along so you don't miss an episode. And until we do this again next week, happy investing, everybody.